Welcome to Alpha Recap, your post-market wrap from stockalpha.ai. We're looking back at a headline-heavy session that left markets pretty scrambled. As always, if you have questions, you can reach us at stockalpha.ai.
Thanks for having me. It was one of those days where the tape told a story about liquidity, policy risk, and a few big winners doing most of the heavy lifting.
Give us the top line. What was the market mood by the time the bell rang?
Broad dispersion. Large cap names took notable hits, certain small caps imploded, defensive names held up, and a handful of secular winners, especially tied to AI infrastructure and industrials, ran hard. It felt like headline risk drove a lot of price action rather than steady fundamental news.
Yeah, big moves. Let's start with the obvious. Intel and Nokia. Tell us what happened there.
Intel finished the day down about 8% on approximately 179 million shares traded. That's heavy turnover, and it suggested conviction behind the selling. Nokia closed down about 7% on roughly 117 million shares, another outsized volume day confirming downside momentum.
So when you see that kind of volume, it's more than a headline, right?
Exactly. Heavy volume is like a stamp of seriousness. It's not just a blip. Traders and portfolio managers were actively repositioning, trimming exposure, adjusting hedges, that sort of thing.
And then the small cap bloodbath. That was dramatic.
It was. One microcap collapsed around 81% to just a few pennies on about 225 million shares. Two others fell roughly 45 and 46% respectively, albeit on much lighter volume. Those moves tend to be liquidity-driven, margin calls, funding issues, or single-event problems. So what really stands out here is the asymmetric risk in microcaps. Thin markets amplify shocks.
Right. Meanwhile, some defensive names actually finished higher.
Correct. Hershey closed at $174.30, up about 1.25%. T. Rowe Price closed at $116.50, up about 1.33%. Those kinds of names acted as ballast on a volatile day.
Okay, we also had a policy shock over the weekend. Walk us through the tariff story.
A new tariff package took effect, and someone promptly filed suit. The headline was a 25% tariff on certain Brazilian imports, and the litigation was filed at the U.S. Court of International Trade. That combination creates real short-term uncertainty because companies don't know whether cost increases will stick or be stayed by the courts.
And legally contested tariffs can have messy timing outcomes, right?
They can. If courts grant injunctions quickly, the hit to margins might be temporary. But if litigation drags on, companies could face sustained input cost pressure. Some analysts expect expedited rulings, others expect a drawn-out process, and the market priced that timing risk into sectors that rely on those imports.
How should listeners think about that in plain English?
Think of a tariff like a surprise tax on inputs. If it's enforced, it raises costs and squeezes margins until companies can pass costs on or find alternatives. If it's blocked by a court, the pain might be temporary. Either way, uncertainty around the timing can force firms to hedge conservatively or delay spending.
Got it. SpaceX had a test flight too. That was tied to their post-IPO profile.
Yes, SpaceX carried out a Starship test flight, their first since going public, and that shifted the risk profile from private milestones to public scrutiny. Successful tests support bullish revenue roadmaps for future launch capacity, but failures or muted guidance tend to have quick impact on public multiples.
That's a key data point. The company moved back into public market accountability.
Exactly. The timeline for technical milestones is now more directly tied to sell-side models and investor expectations.
One of the big themes in the coverage was concentration, a handful of winners hoovering up capital.
Right. We flagged an industrial stock that surged about 533% over 2 years, largely tied to AI infrastructure demand and related energy transition work. That kind of extreme run shows how secular themes can concentrate returns in specific names, even as the rest of the market struggles.
Honestly, I was a bit surprised by that magnitude.
Yeah, that tracks. Momentum can be powerful, But it also invites questions about valuation, margins, and how durable revenue growth is.
Let's pause for some simple definitions. When analysts talk about liquidity-confirmed repricing, what do they mean?
It means a price move occurred on heavy trading volume, not in a thin, sleepy market. Heavy volume suggests many market participants agreed on direction, so the repricing is more likely to last in the short term. Light volume moves can be noise. Heavy volume moves are confirmation.
And when they say policy risk as a volatility amplifier,
That's just shorthand for policy changes, like tariffs or regulations, creating binary outcomes that can cause big re-rating events. Markets hate uncertainty. A new policy, especially one that's litigated, increases that uncertainty and therefore volatility.
we had a section on where analysts agreed and disagreed. Give us the high points.
Analysts broadly agreed on three things. Volume mattered as a confirmatory signal, tariff uncertainty raised earnings risk, and the small cap collapses looked like liquidity events rather than fundamental re-ratings. Where they diverged was on the likely path for the tariffs, quick injunction or protracted legal fight, on how to interpret the Starship test, and on whether the massive industrial run was durable or just momentum that will mean revert.
Short reactions, quick takes,
Tariffs. Timing matters more than headline size.
microcaps, treat as liquidity events until proven otherwise.
AI winners. Strong momentum, but check margins.
Let's dig into implications by investor type. What did analysts highlight for short-term traders?
They noted higher intraday volatility and wider spreads. Heavy volume and microcap shocks can create execution risk. Traders were advised to watch for weekend headlines because legal filings and government responses could create Monday gaps.
Income investors?
Defensive, dividend-paying names provided relative stability, but analysts reminded income investors to verify payout sustainability if input costs rise because of tariffs.
Long-term fundamental investors?
A big single-day repricing, like what we saw in Intel, could be a chance to revisit assumptions about unit growth and margins. But analysts cautioned that policy and technical program outcomes are often binary and slow to resolve, so patience and clear catalyst timelines matter.
Speculative holders of those microcaps? Harsh reality check?
Yes, positions can face near total loss. Recovery usually requires operational fixes or disclosure catalysts. Liquidity was the central issue. Without it, prices can stay depressed.
Institutional allocators?
They were advised to manage policy-sensitive exposures and to consider selectively increasing conviction in secular winners, where the earnings runway looked visible and not dependent on contested trade policy.
Strategic watch list heading into next week. What should listeners track?
First, follow the Court of International Trade filings closely. Injunctions or expedited rulings will matter. Second, use volume as a filter. Big moves on big volume are more meaningful. Third, treat microcap collapses as liquidity events until you see operational fixes. And finally, distinguish true secular momentum from valuation compression risk, especially in AI-linked industrials.
What about the SpaceX angle? Anything investors should specifically monitor?
Track subsequent test results and corporate commentary. Each technical milestone will likely trigger faster model revisions now that the company is public. Earnings models can swing quickly based on program cadence.
Quick cross-check. What would be immediate market catalysts over the weekend?
Court filings or government responses to the tariff lawsuit, any operational updates from the microcaps, and follow-up test news from SpaceX. Those are the high-impact items that could create Monday gap risk.
Before we wrap, a quick note on language and perspective.
Analysts emphasized that sentiment labels like bullish or bearish reflected observed market behavior, not investment recommendations. This episode is informational only and does not constitute personalized investment advice.
Great. Let's end with 3 clear takeaways.
1. Heavy volume confirmed several of the big moves. That's meaningful for short-term follow-through. 2. Tariff litigation introduced timing risk that could act like a margin tax until resolved. 3. Secular winners continued to concentrate returns, but momentum needs to be checked against margins and capital intensity.
Solid summary. If you want to dive deeper into any of these stories, our full written recap is on stockalpha.ai.
And if you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
Thanks for listening to Alpha Recap. We'll be back after the next market close. Take care and have a good weekend.